Things Policy, a daily podcast supported by Pragati, a flagship media initiative of the Takshashila institution. We're a bunch of policy nerds based in Bengaluru, and we like to bring a fresh perspective to Indian affairs and an Indian perspective to global affairs. So grab a cup of coffee, sit back, and join us for today's chat.
Hello and welcome to another episode of All Things Policy by the Takshashila institution. In today's episode, I've got with me Dr. Harshit Kukreja, who works on biology and policy at the institution. But before we get to our discussion subject for today's episode, I just wanted to remind our listeners that our 12-week GCPP program, the Graduate Certificate in Public Policy, the applications are now open. So head on over to the website and sign up for the course if you're interested in what we do. So with that, let me introduce you all to Harshit. I'm sure all of you know him by now. He's done a fair few podcasts. So Harshit, what do you want to talk about today in the episode?
Hey Carl, thanks for having me. So today, we have been exploring different insights from biology, evolutionary biology, and a lot of related fields. So we came across a thing called kinship. So kinship is basically cooperation because of relatedness. And we have talked about kinship in an earlier edition, in an earlier podcast. In this podcast, I would like to discuss with you how financing in kinship works, family loans work.
No, that's interesting, Harshit. Look, I think this is a very important subject in that this is an issue that's faced mostly by smaller enterprises, right? I think we can gauge that those who are in the MSME sector, those who are financially excluded from the banking system, etc., would face this problem probably in a severe way. So can you tell us how does kin-based borrowing usually work, right? And if you could elaborate on the frameworks that you've used here.
Yeah, so first of all, I don't think a lot of people who get kin-based loans or kin-based financing, they would term it as a problem. So kin-based financing is basically instead of getting loans or getting financing or getting money or resources from a formal banking sector or somebody other, you get from your kins, your family. So basically it works. It's a very old system that has pre-existed formal banking systems. It has pre-existed all those systems where there's a person who gives you out money and you have to return it back. Kin-based financing is basically you get money from your family or extended family, and it plays a huge role in a lot of situations and in a lot of people. Two very interesting examples that we came upon was micro, small and medium enterprises, smaller enterprises, and financially excluded, basically the poor people who don't have access to capital.
So the MSME sector, as you pointed out, almost contributes 8% to the country's GDP. And from that, around 45% is manufacturing production, another 40% of exports. So you've looked at the data and you've sort of come to that conclusion that majority of the financing comes from informal sources, right? Which is basically your kin-based lending, right? And it's a big part of
at least in the initial bootstrapping part and for a lot of smaller companies. So
I think certainly there's I'm sure there's greater trust level in this form of lending, and you sort of don't get access to other formal means. So maybe we can talk a little bit about what are the pros and cons of this. So Harshit, in both cases, you sort of bring out insights that there are particular reasons why kin-based lending happens. So could you maybe elaborate on that?
Yeah, so these are the two examples which we found to be very interesting. If you look at MSMEs, the small and medium enterprises, you will see that there are basically 3-4 major reasons because of which they don't have access to formal capital. First reason is, this is in no particular order. First reason is they are high risk investment. So there's a new business, they have just entered the market, or there's a small business which has a small footprint. So it's a high risk investment. And especially in the initial phase, it's very high risk. So a lot of banks and everybody, they don't want to lend to such investments. Even if they want to lend, they lend at unfavorable terms. They want a large interest and they have certain conditions that the company or the organization has to meet. And the second thing is a lot of these smaller enterprises or a lot of these bootstrapping companies, they don't have the ability to back the loan with collateral. So you don't have collateral. It's high risk. So they don't have access to the formal banking system. They don't have easy access to loans from formal institutions. And if you look at the financially excluded, for instance, the poor, they also have the inability to furnish collateral. This is for basically your distress loans, for example, for health, for loans to maybe grow your crops, or anybody, any loans like this. This includes everything. So they have that inability to furnish collateral. They have low financial awareness. They have lack of access to formal banking institutions. Maybe the bank is like maybe 20 kilometers, 30 kilometers from where they live. They don't have the proper documents. They don't know how it works. So they're not able to access the capital. And also, in a lot of times, they don't have access to distress funding. It's called distress funding. For instance, if there's a sudden illness in the family, or maybe they get kicked out of the job, whatever they're doing,
Sure.
then you need some capital to like stay afloat. So you need some capital to cover the expenses, you need some capital to maybe pay for your bills, you need certain capital to pay for healthcare. So that all, because of that, the financially excluded section of our society is also very sort of like relying on kin based networks and kin based lending. And also a lot of our rural societies are very sort of intermingled and tightly knit into communities which they were born for generations. That is why India is sort of thousand of smaller countries, thousand of smaller different countries in one large country. So it's like thousand of heterogeneous communities
Sure.
in fact in one nation.
Yeah, I think, and also we observed how when COVID struck, one of the first things the government, and which we'll get to in terms of the role of the state and the government in sort of mitigating some of these, you could call it as sort of an order of things in that you need some kind of financial backing, you need collaterals to sort of future proof some of the loans that you've given to these MSMEs. But I think what COVID really brought out was their inability to have working capital, right? And that's really something that's important to the functioning of any MSME. Right? You just need working capital, you need a positive cash flow to be able to run a smooth business. And in the event of COVID, when people had to, as you said, use their distress funds for health emergencies, various other things, you don't really have capital to sort of keep your business afloat. And that's when the government sort of chipped in and crores of money that was specifically dedicated for MSME loans and with fairly relaxed sort of loan repayment options. And I think that's again partly to do with how India is by and large a financially sort of weak country. Per capita incomes are fairly low. So what people are going to put into their business is something that is like from a livelihood standpoint, everything that is everything to do with how they want to like carry on their lives of their kin, etc. So it's actually interesting to just maybe delve deeper into some of the pros and cons of this. Like, there are certainly advantages, as you pointed out. Low interest rate is certainly one of them, or maybe zero interest rates. But yeah, do you just want to take us through some of the advantages of in-based financing?
Yeah. So if you look at it sort of from the viewpoint of a person who is not able to access capital, so it's very advantageous because you are getting access to a capital which is easier, okay, which
Yeah.
you wouldn't have gotten through formal banking channels. You get better conditions and better rates. There's no formal structure. So if you tell your kin that I'll return it in a year and you do it in like one and a half, maybe your relations will spoil a little. But that well, you won't get the bank. So unlike the bank, they won't like come after you, sue you, and do some
Sure.
certain things. And they are better repayment. So there are like certain advantages. But I think there are a lot of disadvantages to the kin-based lending and financing system, which a lot of people don't realize.
Sure. So, Harshit, why don't we take a quick break, and once we are back, we can maybe go through the disadvantages.
Yeah.
Hi, and we're back after that short break. So, Harshit was elaborating on the advantages or the pros of kin-based lending. Harshit, what about some of the disadvantages, right? Because as we had pointed out early on in the podcast, that this is a fairly poor country, per capita incomes are low. So this is bound to have repercussions to their financial wellness overall. We spoke about health being a very crucially expensive affair these days. So what do you think are some of the disadvantages of king based lending?
Yeah. The first disadvantage, what comes to your mind, is not that big a disadvantage, but it is a disadvantage. So the first advantage which you think, it is not that big a disadvantage, but if it is a disadvantage because there are personal sort of possible negative effect on ties and relationship. So the familial structure, it weakens because these are like risky loans. You may or may not be able to get them back, and because they are riskier, so there are like high chances you won't be able to get them back, and there's a lack of formal structure and clarity in terms. So because of a poor understanding of risk, plus there's no formal structure, so you won't know what you get and what is the clarity and what are the terms and things like that. So it becomes like it puts a strain on family relationship. For instance, if I ask one of my uncles for money for maybe a company I want to start, maybe a startup I want to start, I ask for maybe like 10-20 lakhs, and then the company doesn't like go off the ground and I'm not able to return the money back to him, and our relationships are spoiled, and I don't, for some reason I don't have access to formal banking institutions, and I get into a health emergency, then he won't come to help me and he won't give me money. So my relationship is spoiled because of this financing thing, and I'm not able to get money when I think maybe needed it more than when needed money for the company. So I think that is a big disadvantage. Carl, what do you think are sort of the big disadvantages to kin-based financing, family loans, and things like that?
Yeah, no, I completely agree with you that the strains this can have on, sort of personal relationship, that's a big one, right? And probably the most common, I would say, in such instances. But I can think of scenarios where, you may have your kin might be from a wealthy background, but, you yourself are from a poor background. So there is certainly an unequal access, of, financial levels there. And I think the capital that you sort of put to use in your business, it can sometimes even have suboptimal sort of use and outcomes, right? It, in fact, since there's no clear checks and balances, so to give you an instance, right, so when you apply for a bank loan, the bank necessarily takes a look at your balance sheet or takes a look at your sort of cash flows and how whether you file taxes, for instance. All of this is used to kind of finance your business, right? Whereas in the case of kin-based lending, there's really no metrics, sort of measure how this capital is done, like, whether this has brought returns for the business and, how is the capital flow moving, etc. So the suboptimal use of capital due to the lack of checks and balances is certainly a problem, and which does have consequences, as you pointed out earlier, from, the negative effects it has on, kin ties. So yeah, that's something which I can instinctively think of being a disadvantage. So, I
Yeah,
mean, look, we spoke, yeah, I think, no, in fact, I wanted to sort of ask you a little bit more on, the lack of the formal structure here and the clarity in terms. So, in an earlier episode, I remember, like, that we spoke on how trust based factors, trust based kinship sometimes
Mhm.
works, like, in favor of people. So, do you think when there is an increased level of trust, right, and there is an increased level of trust in personal relationships, why do you still think you have cases where, and when we look at kin based lending, there is less of clarity? So when you think of increased trust, you might imagine, conversations which are more, sort of more, which has more clarity. You may know exactly what you want.
You are going in the opposite direction because there is a lot of trust. That is why when people don't want to like formalize all of this in family or in kins, you don't want to like sit down and write terms. You should. That is a good thing to do, but not a lot of people. I don't. Majority of people are not very comfortable like sitting down and writing funds. And for instance, if I give like some money to my cousin or something, I wouldn't be like sitting down and writing terms. He'll say, so I'll if I'll give him maybe like 5 or 10 lakhs, he'll say I'll give it back to you in a year. I would be like, yeah, it's okay, whenever you can. And if he doesn't give it back in 1 year, maybe I'll ask him in like a month or two after that. And if he doesn't, he Doesn't. You don't, because they're your family, they're your kin. You don't have that formal structure. Whereas in a bank, you have that formal structure which says that there's a clarity in terms where which says that, for instance, by 31st December you will get your 50% loan back. If not, there's a penalty that you have to pay. So there's a lack of clarity. Do you think that close kins they sit together and work on terms? I don't think that. I have not seen any evidence, anecdotal or otherwise,
Sure.
which is that like family member or kins, whenever they lend money for anything, they say that, oh, so this is the last date, give it back to me within a year, or not, this is the interest rate, this is the.
No, again, I just wanted to bring this topic up because intuitively, I think you can also have maybe cases where, given the increased level of trust, right, you may not want to, for lack of a better word, disappoint that person, right? So you may in fact want to sort of maintain that level of relationship. So yeah, I think, but that's again sort of a peripheral point. But I just thought it's interesting, like, trust can sometimes lead to, is something, maybe cooperation is not the right word I'm looking for here, but trust can sometimes lead to more conformity, right? So you might want to do it, you might want to repay because you want to maintain that level of relationship with that person.
Oh, like
So yeah,
that.
yeah.
So no, imagine a situation. If you have taken a loan from a bank, 5 lakh rupees, and you have taken a similar loan from your kin, who do you think you're more likely to return if the money if you get your 5 lakh?
Yeah, I mean, certainly there's a formal structure to, let's say, a bank loan. So you're certainly more inclined to sort of respect the payment terms as opposed to that of a kin. But I'm talking about a scenario, Harshit, where there is absolutely no access to bank loans, right? So you're looking at scenarios where there is trust-based lending and there is no formal access to banks. So in such scenarios, see, unless you want to be ostracized, right, from a community or
Yeah, that is the
so that's the risk, right? So that's the high risk that the borrower plays with. So yeah, I just thought like trust can in fact have the opposite effects, like in some cases, right? Yeah, and I don't know, maybe this needs further sort of research to sort of buttress the argument. But again, just something that I could instinctively think of.
yeah, so there's a thing called reciprocity in this biological reasoning and everything. So, for instance, it's you and me, we are a dyad and we do interactions. So, the example you gave, in which the village only has kin based lending. So, that means the interaction which I have with you will also create a memory. So, the
Yeah.
next time I ask you for money, you'll remember, oh, the last time he did not return my money.
Yeah,
Or the
exactly.
last time he
Yeah.
returned it, yeah. So, in those cases, you are much more likely to like give back your money. But what I'm saying is there's a lack of clarity, there's a lack of structure. So
Sure.
because of that, there's a lot of contention and there's a lot of sort of like friction. This is not a clear terms and conditions written.
Yeah.
And also, if the suboptimum use of capital part, for instance, the bank has 100 rupees, and though two companies come to the bank for money, so bank will to a certain extent try to scrutinize and see which company is more likely to be more successful. More successful means that much more likely to return back its money,
Sure.
and they'll give it to the company which is like more stable or more successful. Because so that is the optimum use of those 100 rupees, instead of the company B's uncle having 100 rupees and deciding to give it to the company in which his nephew is the owner. So there is no optimum use of capital.
Yeah.
A lot of, I think,
So
capital generation is stopped because of the skin based.
what's interesting here? Like I think in one of the earlier episodes we spoke about nepotism, right?
Yeah.
Especially in the private sector. You could in fact have a scenario where you have a person who's sitting in a bank who has authority to sanction loans, sanctions a loan to, let's say, a kin, over somebody who is maybe the business is doing a lot better. So yeah, I just felt it was.
That is, so there's a us versus them phenomena.
Yeah,
So
I
you
think
are
that's
much
really what.
more,
Yeah, I think that's really what your research is revolved around, right?
yeah. We want to like break these
True. Yeah.
sort
I
of
think
bonds and make
true.
the society more equitable and more progressive and more sort of, we want everybody to like go forward and make it into a better society. Like the eventual end game is that we don't want smaller groups, we want us to like progress as a nation, like hand by hand, like. together.
Okay, so right, so you talked. I mean, we've talked about how for those who are financially excluded, it's sometimes not even a choice, right? I mean, that this is the only access that they've got, which is kin-based lending. But what can the state do? Like, is are interventions necessary here? Since you pointed out that it's important to sort of rise above this tribalism and rise above some of these bonds, especially when it affects economic capital, economic returns. So yeah, what is it that the government can do to sort of ameliorate some of these disadvantages? And I think the biggest disadvantage being the suboptimal use of capital, right? So that's really something which is a big issue for these MSMEs. So what do you think that the state can do particularly?
Okay. Yeah. So I think we'll revolve around the two examples we were talking about. So if
Sure.
you look at MSMEs, I think the first step the state can do is help sort of like formalize the kin-based loan, not put them directly, because you cannot disallow people to give their own money to the kins. You can help them create a regulatory framework which allows for sort of like registration of kin-based loans. So now the friction which was created because of these loans, there was a lack of clarity and everything. So slowly, you are making these informal loans a little more formal. So this way, the government also gets the data. You have some kind of, you can go to the courts because you have registered your kin-based loans, and you also have some kind of, maybe you get compensation, maybe you can, if the company declares bankruptcy, you'll get something. So it is much more likely to reduce friction and things like that.
Sure.
So I think the first step should be like creating a regulatory framework which allows for registration. And so MSME, the Ministry for MSMEs, they offer collateral free loans, but they are not sufficient. And the government should be looking at reducing the requirement of collateral for a lot of other categories of loans, and exploring alternative ways of risk management. Maybe some kind of, I don't know, maybe some kind of,
Yeah, it could be cash flows, no? Like if you have positive
yeah,
cash flow, your working capital does not, sort of go below the level of your borrowing capacity, for instance. Right. So because that's literally what makes the business tick, right? Like you
yeah.
need working
But
capital,
there are
yeah.
like different ways you can do it.
Sure.
Because if
Yeah,
you
I think
take
the
collateral,
collateral based is again, yeah, it's something which is unimaginable for a lot of these
yeah,
MSMEs.
and it's also like it was the traditional way to go, low risk,
Sure.
and you can like always take the collateral. But if you want economic growth in this country, and especially when a lot of people don't have jobs, you should be allowing people to get collateral free loans and sort of allow them to like grow their businesses and maybe take a risk. I don't think you can be very successful in your business if you don't take a little risk. And a lot of people, there's a lot of research which shows that for MSMEs, there's a large reduction, there's a large delay in disbursement of funds. So because I think because they don't have the proper documents and things like that, they are not able to like get loans very fast and from the formal sort of like structures and everything. The fourth point would be that the financial institutions, the formal financial institutions, should be sensitized of requirements of different type of businesses. For instance, you should know that an early startup has this kind of, like, what do you call that, balance sheet, and this is their requirement, this is a legitimate request, we can approve this. They would not be able to give capital, but we can look at this, see how high risk they are, and things like that. So you should, like, people who are dispersing the loans, the people sitting in banks, the sort of the bank, the people who make policies at banks or any formal institutions, should know the difference between an early startup or a well established business, and model the requirements of the loans according to that. So I think this is some of the initial step the government can take for MSMEs and for financially excluded poor. So there are a lot of like interesting organizations popping up for the financially excluded poor. There are organizations like Rangde, which offered sort of like micro loans. They used to crowdsource the money and offer them as micro loans to like people who needed money for health expenses, people who needed money for, what do you call that, like if I'm a carpenter, I need money for my tools, I need maybe 5,000 and 10,000 rupees, and I say that I'll return it in 1 year. So they made those people come on board. So instead of me asking money from my some cousin, and that cousin may be giving it to me or maybe not giving it to me. This is a sort of organizations like this, organizations which help poor get collateral free loans, should be allowed to like prosper. There should be like regulations which allow this to happen. They should not be more like stoppages on their way. And there's a very interesting paper I read. There was a certain sort of like government scheme, and there was a certain organization which was giving out loans, microfinancing for females. And for that loan, you had to get a close male kin to become your guarantor. So these are main loans which are meant for women, and to get a guarantor, which was a close male kin to become a guarantor in your application. So there are a lot of irrational requirements. I don't think this was a formal requirement, but I think a lot of the people who executed the programs, they did it. The people who are like sitting in offices, they did it because they wanted to reduce their risk, and maybe they didn't want to show poor numbers or whatever. Maybe they got pressure to like don't show a lot of loans which are not paid back. I don't know, but this has been seen. So increase the access of collateral free loans to the financially excluded poor, improve financial literacy, let them know that there are formal sections, there are like formal organizations which allow you to have loans at much better rates than maybe you get from informal sources and even from your kins. So, and you have certain kind of guarantees and you get certain advantages and you have free access to capital. And yeah, and I think these are like certain important points which I think if the government will do, we'll be able to like ameliorate a lot of disadvantages that kin based funding has, and maybe make our economy and society use their capital better.
Yeah, and also since you pointed out about crowdsourcing, funds for startups or MSMEs, I think that's really where the market can play a role, right? So making it possible to innovate in this space, and Rangde is a classic example of this, I think is crucial. So moving beyond the government, how can the private sector, how can, let's say, civil society actors, organizations, how can they innovate in this space, to make financial access easier? So yeah, with that, Harshit, do you think that's a good time to sort of wrap up this episode?
Yeah, it was a very interesting conversation. It also took a lot of detours. It was a fun conversation, and I hope the listeners find it, at least they find it somewhat useful. And yeah, please feel like free to contact us. You can always go to the website and contact us, go to our Twitter and contact us. And we will love to hear how you find these new insights.
Yeah, and do feel free to, lend your thoughts, no pun intended.
Yeah. And this would be a non-kin based lending. Carl, I think we should
okay, I think this is about the right time to stop because I think this is a diversion and not a detour. But thanks everyone for listening. Harshit, thank you for sort of sharing your thoughts. You can, as I've often recommended to the listeners, do check out his newsletter called Biology and Society. It's one of the best newsletters that you can read on the subject. So you can subscribe to it. But yeah, we'll be back with more episodes, and yeah, we'll catch up later. Thanks for listening.
Thanks, Carl. Thanks everybody for chiming in.
If you liked our show, don't forget to check out other interesting podcasts on the IVM network. You can tune into them on the IVM Podcast app, ivmpodcast.com, or wherever you listen to your podcasts. You can also follow IVM on social media. The handle is @IVM Podcasts on Twitter, Facebook, and Instagram. And hey, if you'd like to dive into Takshashila's research on technology, strategy, and economic affairs, check us out at our Twitter handle @TakshashilaINST or our website takshashila.org.in.